How did quantitative easing affect interest rates? Imagine a time when traditional ways of lowering interest rates just weren't enough. Central banks needed a new tool to keep economies afloat. That tool was quantitative easing. When interest rates are already near zero, central banks can't cut them much further. So they start creating new money to buy government bonds and other financial assets. This process floods the market with liquidity. As they buy these bonds, their prices go up. When bond prices rise, their yields or interest rates go down. This means borrowing becomes cheaper for businesses and consumers. Lower long-term interest rates encourage more lending and investment. This helps stimulate economic activity, especially during tough times like after the 2008 financial crisis or during the COVID-19 pandemic. Quantitative easing also shifts investor behavior. With government bonds offering lower returns, investors look for riskier assets like corporate bonds or stocks. This movement further lowers borrowing costs across the economy. Historically, central banks used this policy to support financial markets when short-term interest rates couldn't be reduced further. It was most effective when the economy faced low real interest rates and traditional policies had limited impact. But it's not without risks. Increasing the money supply can lead to higher inflation if not managed carefully. Once central banks stop buying assets, interest rates might rise again, which could slow economic growth. There is also the possibility of currency devaluation due to inflationary pressures. Overall, quantitative easing works by expanding the central bank's asset purchases, which boosts liquidity and pushes down long-term interest rates. It became a key part of monetary policy during periods of economic stress, helping to keep borrowing costs low and support economic recovery.